Section this week, what you should expect, and then I'm going to end it off with a risk mastery PDF that I made. This was for VIP, and I decided to make a video on it just because it's something that I believe everybody should focus on. So why I'm going over the most recent, even though we've been doing some of the other ones, is just kind of to show you, because ICT himself sees the current price action. We're trading around all-time highs. He doesn't trade gold, however. He trades NASDAQ, but even then, it's pushing for all-time highs as well. Right? We're not too far off. There's not much price action, right? We have just this weekly FAL Gap that we're revolving around, drawing to. We have liquidity on the buy side, and most pairs are currently running for buy side if they're based off the US dollar. Especially gold, right? We're at all-time highs. We are constantly pushing those all-time highs. Where is it? Yeah, you can see last 3 weeks, insanely bullish. And this is a bearish seasonal month. This is the month of September, right? This first week threw us off right here because we did get some nice bearish, a nice bearish week. But we just traded into this weekly FAL Gap and expanded higher. It's a little more clear on the futures pair. You can see that we actually tapped into this bullish FAL Gap right here on the weekly time frame, and from this bullish FAL Gap we expanded back, and now we had these 3 previous bullish weeks. So scaling it down to the lower time frame, next thing that we would look for is a FAL Gap on the daily time frame, because weekly bias, in order to actually trade it, you have to incorporate weekly profiles. So then you have to go down and look at the days of the week. You have Monday, Tuesday, Wednesday, Thursday, Friday. The week tells you, right? So if we have a Monday right here, opens up, then Tuesday and Wednesday actually run into this daily FAL Gap, and you're bullish, as we have been, you could have expected that from Thursday and even just Wednesday, once we actually ran into this range, you could have expected, because this is the next daily FAL Gap, that we are going to expand back to the buy side. Right? And then within the actual sessions, you can see that we're still getting a lot of buy side. So here's Asia session right here. Right? Asia session starts up at 8 p.m. and we get this buy side run on these highs. London session opens up, right? Even though we run on this low, where does it overall draw to? Buy side. Once again, New York starts up and we run on buy side again. So in these times, what do you even look for? So if your target is buy side, right, there is the risk that once we actually do start flipping around from bullish to bearish, you'll get chopped up in the process of it actually flipping around, because it does take a few weeks, if not a month, to actually flip around completely and start showing you bearish seasonal tendencies and bearish confluences that you can use. So yeah, you might get chopped up in between, but it's okay to just follow the current bias. If we're running on buy side, what you do is you look for bullish confluences. So inside of New York, say you hop into a New York session, what do you look for? So first we started off, this is a 30-minute time frame. We started off with this run, creating the first FAL Gap. This didn't give you an entry, however. Right, 10 a.m. I wouldn't have traded this very perfectly, I guess. But this would be a bullish breaker block. You would take the last bullish candle, you'd look for a liquidity sweep, right? We did sweep liquidity. And now that we're running around, what do you see that formed right here? Is this bearish FAL Gap, right? We do have this bullish one. And while it may look like you wouldn't have had an entry here, this is a bullish FVG, just a regular FVG. So the regular FVG is on the 3 candle range, right? We have 1, 2, 3, and it's the same direction as the candles. So if it's a bullish candle, these 3 bullish candles, as long as there's a bullish gap in between, this is a bullish FAL Gap, and it's just a regular FAL Gap. However, there's also bearish FAL Gaps, right? In a bearish leg. So you can color code it while you're first learning. We have a bearish FAL Gap right here. So if we go before this right here, before this one formed, we had a bearish leg right here. right? And we were running towards the sell side. Once we actually started turning around here and we closed above it, this one became first it was a bearish FVG. But now that it closed above it, this becomes an IFVG, inversion fair value gap. So when you saw this is 8:30. We still don't start trading at 8:30. Some of the students in VIP, I teach them quarterly theory, which we would start trading at 9 o'clock. So the first fair value gap that it would tap into, we would trade from it inside of this range. So you can see that we finally came up above this high, and now we have this breaker block range. So now we're inside of so it was, first of all, a bearish FVG. Now it is a bullish FVG. Bullish IFVG. That's what it is. Right? It's a disrespected bearish confluence, which shows you the need for it to go higher. So now that it closed above and created this breaker block and a bullish IFVG, we're going to delete the breaker block for now because it's a big range. And we're going to focus on this IFVG. So look at what the next candles do, right? We're inside of the 9 o'clock candle. Some students would have already had their trade for the day. But if you trade at 10 a.m., which is the silver bullet, you would have still seen that the next few candles, they stay along this range. And 10 a.m. gives you one more opportunity to get in from the bullish breaker block, right? You would have had your entry at 9:30 if you were trading the IFVG. However, you could have also used the bullish breaker block as your entry from 10 o'clock. So you would have seen that this candle, if we dive lower, would have given you that opportunity to kind of get in from I guess it didn't perfectly tap into it, which is still fine, right? As long as you saw the bias here, a bullish breaker block forming, and it has a higher target. So you would have been able to target the next highs here, which would have formed all-time highs again. Right. But these are the kind of confluences that we look for, and it's a little bit easier as long as you're not getting stuck on the idea that it can turn around at some point. Once it does turn around, sure, you'll take a few losses aiming for buy side, but then you'll be able to switch your bias and start going for shorts. So let's see what ICT has to say about price action. Make sure the volume's up. Okay, he's talking about new day opening gap and just tape reading price action. So he's not trading it, he's just kind of marking stuff out, and he's reading price, where he thinks it's going to go, what confluences he thinks it's going to run into. So this opening range gap CE, consequent encroachment, is kind of like the midpoint. So CE, it's the midpoint. Then he has sell side. And currently it's 9:40 right here in his time, which is EST, New York time. And he typically trades from 10 a.m. So what he's looking for is a potential range for the 10 a.m. silver bullet to run on. So what does he mark out here? Sell side and buy side. Right?
I'm trying to do very little speaking, in case you're wondering. So it's not like there's no audio. I'm just tired of seeing everybody bitch about something I can't control.
I tried to turn off my Discord volume, but I guess it will play regardless. Let's skip over to the 10 a.m. because this is live, so he's not just going to cut straight to it. Okay, let's see this. Okay, what do we have here? So the gap starts from here and it would go until here. So this is the new day opening gap. Okay, I'm a little bit confused. He says this is the high and the low. I guess it looks different on the lower time frame here because he's on the 1 minute time frame. But this is the new day opening gap that he marked out. I guess there was another gap right here. And once it started running down, he marked out the first fair value gap that formed inside of here. And also the opening range gap. Okay, this is because it's a futures pair. So there was a opening range gap inside of futures, and he marked out the midpoint of the opening range gap from here to here, and that would be the consequent encroachment right here. And now he's watching price revolve around this midpoint and see whether it's going to target the sell side on the external range, like chart, like you'll see him switch it right now, or electronic. I don't know what it's called. Electronic trading. I'm gonna check right now. Hours. Okay, electronic trading hours and regular trading hours. So he's looking at the sell side and the buy side here. Okay, so he just marked out the 10 a.m. open right here. And we do have on the 1 minute time frame this 1 minute bearish fair value gap. This might be a good example if price does run up to see how price may respect a 1 minute fair value gap. Once it disrespects it, it treats it as an IFG. So we're just going to kind of watch this a little bit faster paced. And there you go. We just closed right here.
The selling price of.
Let's see. Okay, we finally closed above it right here. Let's see if it actually does pull back and use this IFG. Okay, there you go. Next thing, you don't want to trade right away, right? Because you do not know whether it's going to actually stop and close there. The final deciding factor of whether an IFG is going to be respected is once it pulls into it and comes back and closes inside of it. Maybe even the next candle also pulls in above, comes back, closes above it. That'll show you, like, if you're patient enough to wait for multiple candles to form, it'll give you more things to work with. So let's see. There you go. It closed above. Next candle came down, right? Let's see if this one also closes above. And there you go. So it closed below, right? This doesn't mean it's not going to go up, but it means that your entry from here is invalidated because it didn't treat this IFG like perfectly. Okay, 950 now. So one of the concepts that me and Christian also teach here that isn't widely like known or taught in ICT is macros, which are 20-minute trading periods starting from the like .50 of every hour, the last 10 minutes, and the .10 is when it closes. So it's this 20-minute trading period from 9:50 to 10:10 or 10:50 to 11:10. And inside of this period of time, we expect the like micro algorithm to run on liquidity. So if we ran on liquidity at 9:50, for example, and we were looking for buy side, if we were looking for buy side and sell side. So first, sell side gets ran on, and if we're looking for this buy side, then we'd enter as soon as the macro swept the liquidity at this hour. It's like a double confluence. You're not just trading liquidity, but you're trading liquidity during the times when the algorithm is running. So let's see from right here whether price is going to instantly pull back and create some sort of, like there's this new fair value gap right here. We might potentially use this fair value gap that he hasn't marked out yet to go higher and target the buy side. So you can see we already got an instant pullback from this liquidity at 9:50.
I'm going to go into the 10 o'clock news release.
Okay, there's a news release at 10 o'clock.
After the initial hit of that and the market start after, if so far.
So if there's news, I probably would avoid actually trading exactly at this time. You don't want to trade news at all because, once again, right, you might have had your perfect entry right here. And it would have normally, under normal conditions, ran on the buy side, and you would have gotten your trade from the macro. However, with news, sure, look, you got your perfect entry. You're targeting the highs, and you're almost there. News hits and runs on sell side again. Right? That's why we don't trade it, because news can do whatever it wants. It manipulates buy side and sell side. So it's a little risky to actually trade news. But still, it looks like market is respecting the macro. It swept liquidity, 950, instant pullback. Okay, this candle closed, and you can see right now that this right here, this fair value gap that I was talking about earlier, now became an IFEG. There you go. We tapped into the IFEG. I'd be pretty confident in going in with this one right here, because this one also happened after a liquidity sweep. While this one swept some liquidity, it was a minor sweep of liquidity. This is external range liquidity, where it's outside of the range of like price action, right? This looks like just consolidation, but this is an actual range, and it just swept the actual range of liquidity. We just created a IFEG, and now price can use this IFEG to continue going higher. So once again, we closed below it. We didn't respect it, right? Like I said, in order for you to use the FEG and be confident in it, you want to see it like close into it. Maybe even the next candle closes above it. This one once again disrespected it. So we're not looking for that. We're not looking for an entry. Okay. What he's doing, he just marked out the new liquidity, because obviously news manipulates both sides. So that's what he's probably looking for. Like when there is news, let me pull it up for you guys. Forex Factory. When there is news during the week, we have PMI. Tuesday we have just consumer confidence. Wednesday there is no news. But when we have news like this one, for example, 10 a.m., which is like kind of like this, September 24th. So he traded today's, or like he was watching today's news, 10 a.m. Let me go back. You can find it on the calendar once you pull up Forex Factory. Open up your filter and filter it to only bank holidays and red folder news. Avoid those days. Filter also to USD if you're just trading a USD base pair. Or delete the other ones if you're trading Euro, then have that news on. Right, so that's what he's trading. He's watching the news, and then he's going to trade afterwards. So let's see what happens here. So news just started. We manipulated on the sell side. We have the new day opening gap right below. There we go. We tapped into the new day opening gap. We also have the new week opening gap. I can show you guys on the chart. Let's see. In Q1. So what is a new week opening gap? It's the gap from Friday's close to Sunday open. And kind of like everything else, market draws to fill it because there is a gap completely void of any liquidity. So let's go into the lower time frame. 30-minute time frame. Right, so it's this gap. Once market opens, Friday right here, Sunday open, right? And there's this gap. So instantly, as soon as it opened, the next candle ran down and filled the gap. But this doesn't mean that it's filled, right? ICT talks about balanced price range, and I recommend you guys to learn what that is, because that's how you know that the range is actually no longer going to be like treated. It's not going to be respected as a gap anymore. I mean, to put it short for you guys, if you guys can understand just from this explanation, you need a bearish candle and a bullish candle to close over it like this on the time frame that it formed on. So the highest time frame that it exists on is the weekly time frame. So what you need to happen is the weekly candles, you want to see a bearish candle close over it and a bullish candle to close over it. Then it's a balanced price range. But do some more studying in on that. If there's a gap that only exists on the 30-minute time frame, you could look for it on the 30-minute time frame. Okay, anyways, just looking at price right now, you can see that the draw on liquidity was these lows right under the new week opening gap. It looks like it also swept this low right here. But already from here, you can tell that it's already below the new week opening gap, right? Your initial draw on liquidity was the new week opening gap. On the lower time frame, it filled the gap. It's no longer going to treat it on the lower time frame. And what can you see happen? You can see that we had two fair value gaps form from this. Right? Maybe you wouldn't have gotten your entry here because there's no confirmation here just yet. But now you have confirmation. You formed a fair value gap. You formed an order block with these two bearish candles, right? You now have a high probability order block and a fair value gap. And you can see that price action right here traded back into the lowest fair value gap, right? Because there's also this one. It pulled all the way down into the lowest 30-minute fair value gap, bullish fair value gap. And it tapped into it and started reversing. You can also see that it respected this one. So this is like the most perfect like scenario that you can have, where there's two fair value gaps and the price runs into the lowest one, but pulls back and starts closing around this one. And like I said, you never have to be in a rush. You could have waited for this candle to close. You could have waited for the next candle to close. And then you're like, okay, that looks pretty solid. I'm going to get it now from this candle and ride it to this high. Obviously, this is already late in the day, and you would initially want to find your trade from like 10 a.m. Obviously, on this day, you wouldn't have traded 10 a.m. because we have news. So that means you want to trade later. Models that we have later are like the lunch hour model, where we have lunch hour raid. We wait for 12 p.m. highs to form from 12 to 12:50. Then at the macro from 12:50 to 1:10, we look for a sweep of the sell side. And then from there, we look for buy side towards the highest point that was created during lunch hour, which would be this right here. Or if you have the PM, New York Session PM model, you might have been looking for a trade from 2 p.m. on this day. From 2 p.m. until 4 p.m. And you would have gotten buy side right here. So 2 p.m. to 4 p.m. we got these bullish candles. So yeah, that's what he's looking for. You can already see that he marked out the new week opening gap right here. So he had it marked out before as a potential draw on liquidity. Why? Because ICT's been trading the same exact price action that we're looking at for over 20 years. So he knows that either one of these confluences could be the range that it runs into. And it's not about having them all marked out. It's about like knowing that they exist and then waiting for price to give you confirmations from a specific level, right? So look, once it ran into this, let's skip through it. So we ran below. Now what he's gonna do is look at let's see. He's looking at the 15-second chart. I guess now he's looking for confirmation for it to actually pull back up. So let's keep skipping through. There you go. So here he has a fair value gap right here on the 1 minute time frame. There it is. And he can see that price came back above this fair value gap, or back above the new week opening gap, and into this fair value gap. Okay. By the way, even when price action is, like say it didn't respect this 1 minute fair value gap right here, even when it runs back, that doesn't mean it's not like going towards buy side. That just means that, look, he's looking at the 1 minute time frame. That just means that it's waiting for the higher time frame to close somewhere. So if it wants for the 30-minute candle to close or the 1 hour candle to close, well, it was looking for the 30-minute candles to close. Then that means that on the 1 minute time frame, you have 30 candles of it potentially consolidating within this new week opening gap, because it wants to wait for the 30-minute candles to close in order to run higher. So let's look at what ICT is currently looking at. Here we have the fair value gap and the 1 minute fair value gap right here. We have the new week opening gap. I keep saying fair value gap. So inside of the new week opening gap, we had this fair value gap. And what happened here is, look. So what happens when a bullish fair value gap gets closed below like this? this bullish fair value gap now becomes a bearish IFVG. And this is the exact kind of reference that I was talking about, where you don't have to get an entry from the first candle. You can wait for confirmation. And this is the perfect idea, where you have candles that continuously tap into it, but the bodies all stay below either the entire fair value gap or the midpoint, which is also valid, or even the whole fair value gap itself. It can wick above it. But in this case, it was wicking into it perfectly, but staying below it. Then an order block formed, right? A bullish candle that gets traded below. It's our change of structure, market structure shift. Bearish order block. And say you could have aimed for these lows right here, and you would have gotten your trade right there. I have a level marked out here. I'm not exactly sure what that is, so I'm going to go check it out. Oh, that was the previous day low. Okay. You guys see this? So this is Monday. And now we're inside of Tuesday's range. So we have Monday's low. And you can see that as soon as price swept Monday's low, we started running on Monday's high. And that was Tuesday's entire range. You guys see that? Tuesday swept Monday's low and Monday's high. So inside of the PDF that I wanted to go over, what I was basically saying about Monday is that Monday is the worst possible trading day, right? Most of the time there is no news. This day we did have news, like yesterday. However, most weeks we don't have news on Monday. You can see right here, no news. Bank holiday Monday, no news, right? Let's go back to current week. Okay. So what I'm saying here is Monday typically consolidates when there's no news and no objective because it's the first day of the week. Its purpose is to create a range, buy side and sell side, inside of the consolidation that Tuesday can manipulate. And as I mentioned here, right, we have a Tuesday that manipulates on Monday's high and then runs on Monday's low. This is Tuesday's purpose, where especially when we have news, we typically manipulate on both sides of liquidity of Monday. And then the rest of the week does whatever it wants, like depending on where it's drawing to. So if this week is drawing to this fair value gap right here, then you can expect Wednesday, Thursday, Friday to be bullish, pushing towards the weekly fair value gap and this high right here. Right? Simple. And inside of the lower time frame, you can see what we're looking at here. 1 minute time frame. You can see that the reason why it didn't start running up here once it traded below the new week opening gap for the first time is because its target wasn't yet hit. The target wasn't just the new week opening gap, but it was also Monday's liquidity. Let's see. Monday. Okay, he hasn't marked that out as well. Monday, 3:30 a.m. low. Electronic trading hours low. So he wasn't surprised either. Once it closed below, that doesn't mean that his bullish fair value gap was disrespected. That just means that its target wasn't yet hit. And the fact that he's not trading either allows him to see that market isn't just going to treat the first bullish fair value gap that it forms as a bullish confluence and go higher. It's going to go for its target first before it starts respecting bullish fair value gaps. So let's skip over, right? Let's see if he's commentating on the fact that it's staying below this IFEG.
Yeah. That's here.
New bearish fair value gap. So look, if the confluence, this is a 15-second chart though. If the idea is for price action to go for Monday's low, then it will respect the bearish confluences until it gets there. And it's about to be swept. Monday, 3:15 a.m. discount wick. Okay. That's its wick, but it's not the low yet. So its target has not been hit yet. Not sure if this is a different chart. Okay. There you go. It finally ran on the sell side. So what do you see here? Now that the target is actually hit, right? We finally swept Monday's low, and our bias is bullish because we've been going up the last few days. Going on the daily chart. Where have we been going the last few days and weeks? Buy side. We've been going up. So our initial bias is going to be bullish. We finally swept the objective low. Now that our target is hit, like an algorithm, it has two targets. First, the one on the sell side, and the one on the buy side is the second one. So now that we finally hit that low, we're finally looking for buy side. So we just kind of have to go down to the lower time frame and find our entry for buy side. Like I said, maybe it runs straight away from the Monday's low, as it did right here, and your only entry that you would have taken is from the top right here once it tapped into this fair value gap. That's fine. You still got your entry. You still got your trade, and you walked away profitable that day. This is also another reason why ICT likes looking at the 15-second chart, because you can see 15-second right here on the right side. We had a fair value gap, closed above the fair value gap after tapping in, and ran on buy side. He marked out the order block high right here. You can see that the candle stayed above it. These two stayed above it, and now we ran on buy side again.
It's normal to work the half.
He's just looking at previous bearish fair value gaps now, right? We have this one right here, which was previously respected. Now it's closing above it, and now it's going to use it to go higher.
And then there's...
Okay, you can see we tapped into this bullish fair value gap right here with this wick. Then we also have the low right here, right? Lower low, higher high. That's a breaker block. And he marked out the highest bullish candle right here. So that's a breaker block. Just like this. Lower low, higher high. The highest bullish candle right here. He marks out the body and the wick. Breaker. Look, getting rid of everything else. If your model is breaker blocks, if that's what you look for, then you would have had your entry from breaker blocks. Everybody's model is different. You don't want to overcomplicate yourselves with everything. You just stick to your one model. If your model is fair value gaps in the discount, you would have got your trade right here. As long as you have a model, you stick to it, and you're consistent with it, patient enough to wait for it to form, then you get your entry no matter what. Right, so lower low, higher high. This is the 30-minute time frame. He's doing the same thing on a 15-second chart right here. Breaker block. What's next?
You want to screenshot that?
Okay, new week opening gap high and low. And what he marked out right here is the midpoint of that. That's why he's kind of bragging. He's like, you want to screenshot that? Because it ran right above the midpoint, tapped into it, and ran higher. As well as the previous 1 minute. Right here, where is it? Gonna get rid of this for now. So remember this 1 minute bearish fair value gap. Look at this. So there's two versions of a fair value, or three versions of a fair value gap. Let me show you all three of them right here. You have a regular fair value gap, FVG. That means that there was a bullish candle, three bullish candles right here, and the middle one formed a bullish fair value gap, and that's how it uses it. The next version is an IFVG. You have a bearish leg, and then you have a bearish fair value gap inside of the bearish leg, and then price closes above it. And now this bearish fair value gap becomes a bullish IFVG, and it uses it to go higher. That's a bearish fair value gap turning bullish. The third variation is a bullish fair value gap getting respected again. So we have a bullish fair value gap right here. Bullish fair value gap, just like the first image. And what happens then is that price closes below the bullish fair value gap. Right? We closed below because the target was a little bit lower. You were trying to use it, but it wasn't time yet to use it. It wasn't time yet because it still wanted to sweep Monday's low, right? Just like the example. Monday's low. Now that Monday's low has been swept, price begins running back up. And once it closes back up right here, we're still targeting a higher target, which would be this new week opening gap. So now this bullish fair value gap, which became an IFEG, gets respected again. This is called a bullish Reaper fair value gap. That's what ICT named it, Reaper fair value gap. And then price comes back into it like this and then goes higher to its new week opening gap target. I'm getting a call right now, but maybe write this down, find an example on the charts, send your questions in the chat. I'll get to you right now. Okay, let's see if you guys wrote any questions. Nope. Okay, we'll resume. So, right, we have a bullish fair value gap, a IFEG, which is a bearish fair value gap that becomes bullish after it disrespects it, and a bullish Reaper fair value gap. It's quite simple once you understand it. This just means that it wasn't yet time to use this bullish fair value gap, and it wanted to take out the low. So in a scenario just like this, you can see that the initial target was down here. So why would it use a bullish fair value gap to go higher if the target was still lower? So it instead used it as an IFEG, took out the target, now it's coming back. What is price action going to use here? We do have this fair value gap, right? But once we already closed right here, why would it come down and use this one when it already has this one right here? So this bearish IFEG becomes a bullish Reaper. And it uses it right here, closes above, comes down perfectly to the dot of the low. There's actually some room. I just marked it out incorrectly. But there you can see that it closed above, respected the bullish fair value gap once more, and it used it to go higher. And the other thing that he marked out was the midpoint of this range right here. Momentum. There you go. That's what it referenced perfectly. You can see new week opening gap, midpoint, tapped into the midpoint, bullish Reaper fair value gap, and we started running off like crazy. And like, this is how we expect you guys to study. we, just like ICT does, like, why does he have all these things marked out? Because everybody trades in their own way. Breaker block, IFEG, whatever your model is. He teaches all of it. And then what he does is he live streams tape reading, marks it all out, so that you can see every single one of these confluences is used in its own way. You just have to make sure that you build a model out of a specific one and use it like that. Once you see the confirmation, once it sweeps Monday's low, starts running back up, creates the breaker block, then you could use the breaker block or the IFEG. It's quite simple. You just have to study, figure out the concepts, watch how they're used inside of the chart, and then go into your chart and actually trade from them. Let's see if he marks anything else out. I don't think you guys really need to know like the new day opening gaps on external range or electronic trading hours and real trading hours. That's not something really important to note, especially because the same stuff works on every pair, right? XAU, which doesn't even have that. So there's no point in like digging too deep into what that is. If you want to learn and that use that as an additional confluence, I'm not going to stop you. Go into his charts and learn that from him because that's what he teaches. I already decided at some point that I didn't need to learn the difference between electronic trading hours and real trading hours. That would be on futures, right? Is it on a lower time frame? Yeah, there you go. Regular trading hours. It just shows you the gap once market opens at 9:30. It's like a stock, basically. You know how stock market opens at 9:30? There's the volatility from that time. It just has an additional gap, which you can reference as well. That's what he references right here in this chart. It's an additional confluence that you can use. It doesn't mean it's a necessary confluence to learn because, look, price is up here now. It's no longer going to reference it. So you can avoid trading it. If it's too complicated for you to learn, don't learn it. Alright, that's going to be all for today's call. Thanks for hopping in.